So who wouldn't want to manage their capital in a vehicle that just gets the compound tax free?
Google and Amazon spent about $25 billion. And the top tech companies probably spend about $150 billion in total. And if you just look across the broader US market itself, there's about $350 billion of stock compensation that goes in.
In the end, just think white hat version, black hat is old school. We're trying to vanguardize this crap.
I was dealing with the problem, met with the traditional exchange fund providers, and just kept getting told that it is oversubscribed and we cannot take Uber. And that made me really curious as to why there's a product out there that has this incredible value prop.
What else you got, Dave? Throw more rocks at this thing. Try to break it, man.
Hi, everyone. Thank you for joining us on Excess Returns. Today, we're going to be tackling a challenge some successful investors face, and that's what to do when one stock becomes too big a part of your portfolio. So whether that wealth comes from years of working at the same company and getting that company stock or a big investment win, today with our guests, we'll explore strategies and vehicles that they're working on to help reduce risk, manage taxes, and take advantage of diversification. So to help us understand these options and what developments are taking place now, we're joined by Wes Gray, founder and CEO of Alpha Architect, a systematic ETF issuer, and also CEO of ETF Architect, a platform that allows firms to launch ETFs and or convert different vehicles to ETFs, mutual funds, hedge funds, SMAs, and also ETF conversions, which is what we're going to be talking about today. So hello, Wes.
How we doing? Thanks for having me, guys.
Sri Narayan, founder and CEO of Cache Financial, a firm offering exchange fund solutions for concentrated stock positions. I like the tagline, Sri, a modern brokerage for your large stock positions.
Thank you.
And since we're talking ETFs, innovation, and investing, I could think of nobody else to come in and join us than no other than Dave Nadig, who will be guest hosting with me today. Dave is a thought leader on ETFs and the investment landscape in general. So really appreciate your help, Dave.
I really appreciate the opportunity. Let's get into it.
Yeah, and you can follow along with Dave at nadig.com to just see what he's talking about. A lot of interesting stuff. Okay, so Wes, I think just start out, we got to put some context and definition around this because we've had you on before talking about 351s, but obviously a lot of people that are going to be listening to this is going to be a new concept. So just walk us through what a 351 conversion actually is and kind of maybe originally what got you kind of into this.
Yep. So broadly speaking, just stepping back 40,000 foot view, as you guys all know, I'm sure a lot of your listeners know, the ETF wrapper itself is amazing, right? It has this very unique ability to essentially compound tax free because we don't have to, typically distribute capital gains. So who wouldn't want to manage their capital in a vehicle that just gets the compound tax free and then you don't have to pay the taxes when you sell the thing? Great. Everyone knows that. But then we got problem number 2. Well, Wes, here's my issue. I would love to do that, but I have all this low basis in all these random stocks, overpriced ETFs, mutual funds, blah, blah, blah. And if I want to go into the beautiful ETF wrapper, I got to pay a huge tax bill to get there, which defeats the whole purpose of being tax efficient in the first place. So how can you solve that? Great. There's a thing called Section 351, which is a section of the code that says you can contribute property tax-free to fund a new C corporation. And then, ETFs and mutual funds are structured as C corps, but they elect to be taxed as a RIC, a regulated investment company. So of course, 351 has some additional hair, and they say, great, you guys can contribute your low basis property tax-free into these new ETFs you're creating if and only if you contribute diversified portfolios. And diversified portfolios are very well defined in the statute. No security over 25% of the contribution, and the sum of the top 5 securities you contribute can't be more than 50% of the total. So we kind of solve the ability to move property into the ETF tax-free, but it has this limitation. And what do you think happens on every single call we have? Hey, Wes, I got $100 million of Tesla. Can I do your deal? No, you can't do my deal. Hey, Wes, I got $100 million of Berkshire. Can I do your deal? No, you can't do my deal. Go talk to someone else. So you get tired of trying to explain this thing. And so that's where this new innovation is where Sri comes in with cash. Now we can deal with that problem as well. So that's kind of like the long story short on, ETFs are awesome. I'd love to invest my money there. Great. How do I get my property into the thing? Great. There's constraints. Well, how do I get, around the constraint to still get my property in there eventually? That's kind of what we're working on here.
Yeah, no, that's cool. So let me ask you, do you think, because Sri, we were talking before we started, and you can tell this story, but you were giving the example of how you worked at some of these tech companies, and you had the stock, and all your, colleagues and friends around you had this concentrated stock problem. Hence, you founded Cache. And and Wes, you may have, and maybe Dave too, you might have some perspective on this. I wonder if the concentrated stock issue or problem has actually gotten worse or magnified by what's happened in the market over the last 10 years with, I'm thinking the Mag 7 and that. So is that something you guys have kind of seen more and more?
So I would say I'm in the epicenter of where this problem can occur. And most people don't realize how bad this problem itself is. And there is a primary contributor to what creates this problem, which is stock compensation. You work at a Meta, you work at a Google, you work at Uber, or you work at OpenAI. Most of your compensation is in the form of stock. And the higher you are in that ladder, the bigger the proportion of your compensation is in form of stock. Next, over the last 20 years, all of these stocks have done incredibly well. So you have both of these forces that are propelling this. Let's talk in numbers. How much do these companies spend on stock-based compensation? Last year, Google and Amazon spent about $25 billion. And the top tech companies probably spend about $150 billion in total. And if you just look across the broader US market itself, there's about $350 billion of stock compensation that goes in. And the way that I think about it, a lot of folks that are on the receiving end, it is just a piggy bank that your company just deposits shares into. And you don't even think about it. It is just coming in. Doing nothing is the easy option. So you just let it be there. And 10 years later, you wake up, that $10,000 of Nvidia that you bought on ESPP is now $5 million, and you got to deal with that problem. That is the magnitude of the problem that we're seeing. And yeah, you're right. It is especially a problem at the Mag 7 and the big tech, because those have had incredible run-ups, and they're just very, very generous with stock compensation.
Yeah, and I would say, just from talking to financial advisors over the years, this has become a bigger and bigger onboarding problem. And that tends to be where advisors face this, is they have a new client, somebody makes them a great referral from the Nvidia C-suite or something like that, and they're faced with this massive position. And while the technical issues, which we're going to get really into the weeds on, it's worth pointing out, there's often a big psychological issue. A lot of times these rather wealthy people don't feel particularly wealthy because all of their wealth is tied up in this one stock position, and it sort of feels fake. They have, $300,000 in net assets and $4 million in a single stock position, and they feel guilty about doing anything to diversify that. And that guilt, frankly, I think keeps a lot of folks from even signing up with a financial advisor, because it's going to involve having to say that they're selling the company that has made them rich. And that is a tricky position to be in.
So we'll get to the development, what's coming down the pipe here. But in terms of exchange funds, let's just talk about what options are out there now for investors, and I guess what Cache does, if you want to answer that, Sri.
Sure. Happy to. So as I was telling you before the show started, I came into this because of my own personal situation. I was an early employee at Uber. I was working at Alphabet, and a lot of my own compensation was in the form of stock that had all performed quite well. And I was dealing with the problem, met with the traditional exchange fund providers, and just kept getting told that it is oversubscribed and we cannot take Uber. And that made me really curious as to why there's a product out there that has this incredible value prop. Nobody around me has ever heard of it. I mean, my colleagues, especially at Alphabet at that time, everyone around me had been at Alphabet for like a decade or two, and they all seem to be talking about the same issue, which is that, hey, a lot of my net worth is an Alphabet stock, but they don't even know that there's something called an exchange fund. That's what got me curious, started digging into it. The traditional providers, like the two out there, are Goldman Sachs and Morgan Stanley. And they've been servicing the private wealth industry for the last 50 to 70 years. They really started as institutional products in the 1960s. The one thing I would say is they were created in the 1960s, 1980s, those two products, and in a way they kind of remained there. They're still like brokerage products, and the main channel through which they're sold are wirehouses. You have these huge minimums, you have these high sales fees to get in, and it's really seen as a tool to onboard a new prospect. You want to help them with concentrated stock positions. You bring up an exchange fund and like get them into your broader wealth ecosystem. The problem is they are all building these exchange funds around broad indices like S&P 500 or Russell 3000. And when you think about, especially over the last 20 years, how various sectors of the economy have performed, there is clearly a few winners. Communication services, technology, they've done incredibly well. And you have a case of a lot of these folks that hold highly concentrated positions in these stocks that go to the exchange fund providers and say, I want to contribute to the stock, but there's no capacity, because to create a balanced fund, they need stocks from all sectors of the economy, but there's nobody coming in from utilities or real estate or materials, whatever sectors of the economy that they need to fill the holes in. And that just backlogs everyone. And from what I know and heard, they just reject a ton of folks coming in with these technology stocks. So that was the insight that got me into this. And I was working at Uber. It was all about supply and demand management, and thought about how we can manage the supply and demand better. So we started with, hey, let's create an exchange fund built around the NASDAQ 100. All of these are high growth stocks. They'll just be better matching abilities because you're matching like for like. And that's what we worked on for almost 2 years before we launched, and launched it just about a year ago. Instantly took off, and like over the last year, they've created funds for both accredited investors and qualified purchasers, and grown to over $400 million in assets across these funds. But the holy grail is still broad market diversification, and that's where we got to talking with Wes and thinking about how we can better solve this particular issue.
Right. So I'm an investor. I have $10 million in Google. I come to you. I give you my Google in an exchange. As a investor in cash, I now hold a diversified basket of, like in this example, NASDAQ 100.
That's correct.
Stocks.
Yes.
Right.
Mm-hmm.
Okay.
Yep.
Okay.
How can you talk a little bit about the actual mechanics of that? I don't mean to be stupid about this, but like take Justin's example. I'm literally going to ledger over $10 million of Goog. That's what I'm ledgering over. What do you do with that? If you've only got $100 million fund and I give you $10 million in Goog, you're now massively overweight versus your target exposure. How are you handling that actual? I mean, are you just immediately selling a whole bunch of it? Are you like, what's the process for doing that in an efficient way that doesn't just create an enormous amount of internal churn?
Great. So Wes talked about 351, and now it's time to talk about what we call a cousin of 351. And there are a couple of cousins. Everyone knows about 1031, which applies to real estate. There's a similar one called 721, which applies to partnerships. And 721 says contribution to a partnership is not recognized, like there's no gain or loss recognition as long as it meets certain criteria. That is what you're really doing in an exchange fund. A lot of folks come and pool all of their assets in a partnership. And if you gatekeep who comes in, who doesn't come in, how much they come in with, you essentially have a very balanced portfolio. And to your point, if you're trying to build, let's say, $100 million exchange fund, and somebody comes to you with $10 million of Google, you have to figure out how much Google do I want in this portfolio, and do I really have $100 million of capacity outside? How much can I say yes to this particular person? So you're constantly playing this game with hundreds of investors and trying to figure out who brings what and how we create this pool in the middle that is balanced and can approximate the benchmark that you're trying to hit. To your next question, do we just go ahead and sell it? That is not possible. A partnership is a porous structure, which means that any sale that happens just bubbles up to the investor that contributed, and there's a tax recognition. And that is where, like, exchange funds are handicapped. The only way you get to that balance is by telling this investor, hey, bring exactly like 1.5 million, to some other investor, bring exactly 4.5 million, and playing that game with 70 different stocks and hundreds of investors. That is the NASDAQ 100 game that we've been doing, and that is the way that the bigger exchange funds also have to onboard and balance.
So what is it that you've cracked here? Because everything you described sounds like exactly like the problem statement you gave for why Morgan Stanley isn't able to do this as well. Because if you got 35 investors that all want to unload Uber or Google, then you're in the same position as they are, having to say no to everybody, right? So what is it that you're doing that's actually unique that's making this better?
Yeah. So Wes talked about 351s and how you can contribute a diversified basket and get ETF exposure, right? So what is an exchange fund? It is a diversified exposure across lots of different investors that are contributing into the fund. You can take that exchange fund and use the 351 as a tool to achieve rebalancing to hit that target benchmark that you want to hit. Creating an S&P 500, which is what we're launching. An S&P 500 is a much harder problem. NASDAQ 100, you need like folks from whatever, at least 60 to 100 companies. That is what we target. S&P 500, you probably need at least 300 companies to kind of get close. It is a much harder problem. A lot of folks have tried and failed, and there are only two big players that have been able to keep those funds running, but there's also never any capacity. The unlock here is we are able to create like a diversified pool that looks as close to S&P 500 as possible, but also use 351 as a tool to rebalance out and get exposure to stocks that we're never able to get organically because there's nobody holding low basis stocks.
Dave, let me
companies.
Maybe explain this from a different angle, right?
Yeah.
So I have to accept diversified contributions individually. If you have Microsoft, Justin has XYZ, we can't do this. But a partnership with a pooled 351 qualified, I can accept that into my fund. And to the extent that I'm already out there accepting diversified like contributions, which we are, because we're getting all these like frozen, dead, tax loss housing portfolios, what have you. If Sri and their team come with me at like a NASDAQ 100, or obviously like a heavy Nvidia, heavy Apple, I've already out syndicating contributions. And if that aggregate pool, it's like, oh, well, great. Are you guys have a 351 qualified contribution? You can get added into my swimming pool here, right? And then now, as you know, the ETF structure has a lot of magical powers, to maneuver, adapt, adjust to whatever we need to do to fulfill our prospectus mandate. And we can do so in a way that is tax efficient, right? So I can't take 30 stocks in my exchange fund and then go sell them all and go buy the SP 500, because that's defeating the whole purpose of the exchange fund. So option one is like, well, to Sri's point, let's go call 10 million people and find the exact market cap weighted contributions of every person that could ever do exchange fund. That's a coordination issue that's literally impossible. Well, that's why we're inserting the integration of the two capabilities here to be able to facilitate effectively that, but through a mechanism that's actually feasible. So we unlock this whole problem. That's what the problem you're mentioning is the problem that has been solved.
So this is a multiple step process. If I'm the rich investor with the $10 million of Google, step one is I call Sri and I say, do you have room for $10 million in Google in your next exchange fund? And you say, no, I can take 5. And then because you've got other commitments, and then some amount of time passes, and then eventually I ledger that over and I now own shares of the exchange fund, which theoretically doesn't have to be the whole S&P 5, the whole NDX, right? You could just have 13 stocks and it's a little unbalanced for a while. And then you take that exchange fund once it's instantiated and everybody's on their 7-year lockups, right? None of that all still exists. And then you exchange the assets of the exchange fund to Wes in exchange for a single holding, which is all those ETFs. So now the exchange fund effectively has a 7-year lockup on Wes's diversified ETF. Is that right?
That is partially right. The way I would put it is we're not taking all of these stocks and
You're close, Dave.
pushing it into the
Yeah,
ETF, but
exactly.
it is a tool for us to navigate the exchange fund portfolio towards the benchmark that we have chosen. So it wouldn't be, hey, let's call up 13 people and get all of their stocks and push it into the ETF. That isn't probably kosher from a regulatory perspective. But yeah, you're trying to build towards the S&P 500 or NASDAQ 100 or whichever benchmark. And you can use one of the portfolio management tools is a 351.
Got it. Okay.
And,
Interesting.
Yeah, there'll be portfolio management at both layers, the exchange fund layer as well as the ETF layer.
Yeah, and just so you're roughly you're obviously got the big muscle movement, Dave. But as you can imagine, like, well, I can take 10 mil, but like we have constraints too. Like I can't take a massive Microsoft position because I'll be out of prospectus.
So the diversification happens in the exchange fund,
Yeah,
right?
yeah.
Because you're getting close to NDX or something in the exchange fund, close enough. And then you take a bunch of those positions, not all of them, and you do some exchange. And now the fund owns a bigger chunk of something that's more diversified. But am I right that the exchange fund still has to have more than 20% completely illiquid to qualify as an exchange fund? So what do you do? That's traditionally real estate. What are you doing in that bucket?
Yeah, so all of our existing exchange funds also have to fulfill that, and any exchange fund has to fulfill that. Instead of like looking at it as when we were starting this company, let's go become a real estate manager, because that's what the existing exchange funds do. They are essentially a forced buyer whenever there's a close, and they have to go search for real estate deals in like random parts of the country and buy like multi-family housing, and they need to go deploy. I need to go deploy 100 million, 500 million, whatever of my money and buy up all these properties. We thought that model was suboptimal for a lot of reasons, operationally inefficient. But again, you're essentially trying to time this purchase along with your fund close. The other party knows that you're a forced buyer and you're not going to get the best deal, and you'll end up with a middling real estate fund and a middling real estate return. The way that we've done it is we just went out and looked at who are the best real estate managers in the country. Let's talk to 15, 20 of them, and let's have a syndicate, and let's invest into their least risky part of the real estate spectrum, like the fund that we operate. So we only invest in core, open-ended, diversified funds that have thousands of properties in them, and usually also follow the NCRI policy.
And Sri, another thing you may want to explain it, because it's also confusing, is that you have the 20% qualifying asset. So explain how that works. Like if you put in your 10 mil Microsoft, like you don't get 20% real estate, 80% other stuff. Like just map it through how that works with leverage.
Yeah. So the way it works is, let's say we close $100 million fund. To to get that 20% real estate, we're not going out and selling $20 million of stocks because, again, that's a porous taxable event, and you'll end up sending a lot of tax bills for this highly appreciated stocks. The way all exchange funds work is there is a credit facility on the exchange fund portfolio itself, and there's a modest amount of leverage that is invested into real estate.
Okay, so you wait until you've got an extant portfolio, and that's what you're margining to go get the 20% that you need to keep your compliance, and you're just using private real estate funds for that.
That's good.
Got it. Okay, that's clever. What about costs? Like this whole process. I mean, I know. I'm sure there is a fee for the exchange fund on an ongoing basis. There are a fee for Wes's funds on an ongoing basis. Yeah. Other than those annual fees, which I'd love to hear the numbers for, what else gets lost in the shuffle here? Are there transaction fees? Are there subscription fees? Are there, do you have to have your own lawyer run up a trust? Like, what's the actual all in for that $10 million Goog investor?
Yeah. So there are no subscription fees, no sales commissions. Everything is very clean. Our fee is just like public and open to the internet. Anybody can go check it. We have what is called a retail rack rate. It starts anywhere from 40 bips to 95 bips, 40 bips for 25 plus million, 50 bips for 5 million, 60 bips for 1 million, and kind of tapers off. And
to be clear, that includes the ETF fee too, Dave. That's like
right.
the all-in cost, because the objective here is like extreme affordability, but we're able to do this profitably with some profits, obviously.
Yeah. And there are expenses at like the fund level, especially at a private fund, in terms of custody as well as administration, audit, and tax, but those are quite skinny, and we have a big complex of exchange fund already, and we're growing even more. That those are all fixed fees that will come down over time. We target anywhere from like 10 to 15 bips of operational charges that will be charged to the fund as a whole.
Yeah, the objective here, Dave, just as you can imagine, like we're basically taking this out of the basement of wirehouses, which is all about structured product, fees on fees, sales, all the skis ball stuff that you like with the black hat guys. We're going white hat. We're going to make this as lean and transparent and efficient as humanly possible within the law. We have to follow the laws, of course, and that that increases costs. But in the end, just think white hat version, black hat is old school. We're trying to vanguardize this crap. Is the summary.
Well, the big hang up on exchange funds still exists, which is the 7-year lockup, right? I mean, that's fundamentally, that's the actual advisor conversation is you have $10 million in Google, you could sell right now and pay an enormous amount of taxes on, or you can effectively swap that out for a more diversified portfolio that'll also get you a little real estate, but you can't get it out for 7 years. Like that doesn't go away, right? That's the big gate.
That doesn't go away, but when you think about it, like illiquidity is essentially what you can access in your portfolio. If you're holding 10 million of Google, that is illiquid as well, because you don't want to take that huge tax hit. And even if you sell and diversify, for most of our clients, what we've seen, they don't need to access that capital. It's all their long-term savings, and they're just going to put it in an index fund and let it run for the next 30, 40 years. They don't think of this as such a huge barrier. It is probably a barrier that got exchange funds a bad rap before, but once people rationalize and think about how much liquidity do I want? Do I really need to put 10 million of Google in here if I only have 13 million? Probably not. Let me start with 2.5 million. That is my long-term savings, and that I consider illiquid. I'm not going to touch it for another 30, 40 years anyway.
Does the lockup also apply to the ETF shares, or is that just the exchange fund?
So it's just at the exchange fund level.
Okay, so once you convert, and you go to the ETF, it becomes a liquid.
Well, but you still own the contributor still just owns the exchange fund. The exchange fund now owns the ETF. So the individual investor doesn't own the ETF except through pass-through, right? I just want to make sure I've got that right.
Yes.
So I still have that exchange fund, which as a private placement, I think I'm right, that would still be eligible for like signature loan, right? So if I had a $50 million position in this exchange fund, theoretically I can go to Citi and I can get them to rate me a loan against that and use it as collateral the way, you know, Elon Musk does with all his comp and everybody else does with all their comp. So that I could see. Okay.
And that whole process itself, we're looking at making it simpler, especially since the collateral now is a lot easier.
Well, it's liquid.
to build.
It's you can measure it. It's probably a lot less subject to valuation concerns, et cetera.
Yeah.
And
To what extent would
interesting-
you would you hold private securities in here as well? So if I come to you with my SpaceX position, theoretically, I'm guessing that can live in the 20% illiquid bucket, but it makes it much more complicated to keep the rest of the portfolio at balanced. Is that on side here, or is that a problem?
So private stocks wouldn't be considered illiquid. They're still securities. It would fall into the 80%.
Okay.
And people have tried private exchange funds for a long time. There have been a couple of them that have been tried in the 90s and 2000s. They all eventually don't work out, mostly because there's no mark to market on all of these private companies. It's whatever one venture capitalist gave them value on. And the further out you go in how close they are to later stage and how close they are to public, it probably gets safer. That is a conversation we have had. Can we put SpaceX? Can we put Stripe? Can we put Databricks into our NASDAQ 100? Because these are all massive companies that are very close to being public, and a lot of their employees might want to have diversified exposure even without waiting for whenever that IPO might happen. There are no rules that say we cannot have private stocks in there, but doing a completely private exchange fund, I think there are still a lot of issues there, especially the further down you go.
Yeah, and definitely can't then just transfer those into Wes. I get that. Big basket of stuff that's never traded. I think that's explicitly not on the list.
Yeah, Apollo's got to do a lot more lobbying for that to be able to happen.
Give it a week, man. Give it a week.
Yeah, give him some time, baby. But yeah, it's just fundamentally doesn't work. And to your point, Dave, you'll find this interesting, I think. It is, to Sri's point, 351 and exchange funds are cousins because they were legislated and discussed and argued about 50, 60 years ago. And basically the service is like, listen, we're done with all you guys doing all your financial engineering to go from a stock to diversified, tax-free, etc. And so that's why they said, hey, 351, you can use it, but you only get tax-free treatment if we think you're already diversified going to diversified. But if you try to do this little trick without any baggage, we're going to ding you. And then so they say, if you want to do that trick, you got to do the exchange fund. But now we're gonna penalize you with a 7-year lock if you want to get that benefit.
Right.
And so to your question, if anyone solved the 7-year lock, they're wrong because it's going against literally the legislative intent that was put in place in the first place.
Oh, I get that.
Yeah. So everything we're doing here is just making the current intent, but we're fulfilling it efficiently so people can actually do what the whole law was kind of really set up to be able to facilitate.
Yeah, I get that. What happens at the end of 7 years?
You get, so let's think about the historical case and let's think about what is a major breakthrough over here as well. Historically, you would have these exchange funds that probably held 2,000 plus stocks, and you would, the fund documents would say we can distribute 10 to 20 stocks at the discretion of the portfolio manager. And that is a big fear for anybody getting into it. I might not even recognize any of the 10 to 20 stocks I'm going to get at the other end. It is not likely to be a long-term hold for me. So the way that this particular model works is you're going to get ETF shares that you can continue to hold forever. And since there is essentially some equity that is managed at the exchange fund level as well as and the ETF, what we're planning to do is look at the portfolio as an aggregate and think about how we can make a distribution that gives you a representative sample and gets you as close to the S&P 500 or whichever benchmark in terms of risk profile.
But the mechanically, what happens is you get shares back. There's no selling. There's no transaction that happens. At the end of 7 years on some sort of schedule, it sounds like there's some variability in that. It starts handing investors back securities. That basis was set when the exchange fund was started. Is that right?
The basis is when they purchase the original shares.
When the individual shareholder.
Yeah, the Google shares.
Right, got it. So they maintain that basis, but now it is applied to the ETF shares they're getting back.
That's correct. Yeah, right.
So you're not getting any sort of magical step up in anything here.
Yeah, there's no step up, but it's essentially tax deferred compound.
Yeah, got it.
Putting a lot more of your capital to work.
And Dave, let me, because you'll appreciate this, because we're already dealing this in 351 world where people are getting this hodgepodge portfolio coming out of a dead exchange fund. And they're like, great, now I have this idiosyncratic portfolio of a bunch of junk that has zero basis. It's terrible. I'm back to where I was initially. Can I 351 that into an ETF? Because as you know, ETFs are beautiful, low cost, transparent, blah, blah, blah. Or they have, these counterparties that will remain nameless to say, oh, well, actually, you know what? You can hire us to buy another service we have, which is tax loss harvesting program. And you can pay us, like they want to keep the life cycle of like rape and pillage forever, right? which is what, no, after 7 years, you should get delivered a beautiful, nice, transparent, diversified basket that you really shouldn't have to mess with too much on a go-forward basis. So we're solving the back-end problem too, which is just leaving you with another problem in a different form that can upsell you to another service, right? So that's the other kind of nice thing I'd say that's about this kind of innovative structure Sri's got cooking here.
Well, let me push back on that a little bit.
Sure.
I mean, I think the tax loss harvesting sort of at the direct indexing level, I could easily see a world where I've sat in this thing for 7 years. You've now pushed me out, $1 million of shares in your ETF.
Yeah.
Now I still have a tax problem, right? I still have a low basis problem. Now is probably the appropriate time to put that into some sort of DI platform where you can sort of slowly burn down what is now a diversified position against a diversified portfolio. That's way cleaner tax math to me than the single stock position version of the DI tax loss harvesting thing.
Yeah, no, for sure. After the fact, if you're like, hey, for whatever reason, I need to generate some losses, you say, great, I have a diversified SPY clone collateral. That's pretty easy to run harvesting systems against. If you needed to continue to generate pass-through losses after that for whatever reason, 100%. Yeah.
Okay. All right. It's a cool little set of tools you've dumped into the middle of the ecosystem. I like it.
So is the idea here to have like vintages almost? Like you have the exchange funds and then, there'll be ETFs that will be matched with, as the assets kind of get to the point in the exchange fund when you sort of think it's big enough for an ETF, you do the 351. Is that the idea?
I wouldn't quite say that is how we would do it, but an exchange fund is a perpetual vehicle.
Okay.
Like it'll just continue onboarding. And the way that we've built and like made it operationally efficient, we can onboard every 2 weeks. Once we launch this fund and like do some rebalance and get it closed as well, we'll continue to do bi-weekly onboarding, and every 2 weeks we're taking in stocks that help us. And the 351 is essentially a tool for us to say we have like portfolio drift and we're not able to source some sectors, some stocks. Let's take that and use the 351 to gain exposure so that we get close to that tracking error line again.
And Justin, that's a good question. And we'll explain kind of like the framework here. So 351 in particular requires that the transfer group basically own over 80%, but basically got to own the whole thing, which means every time you do this, you need to basically create a new ETF. Right. So, and obviously, as you know, as a former ETF operator, you don't just like whip out ETFs every day. Right?
Well, you do.
So even we can't do that. But all these things have like a 6-month pipeline before, it's a nightmare.
You're not doing it every day. Yeah.
Yeah, we're not doing it every day. I mean, we're launching maybe other people's ETFs every day, but like if we're going to launch a new like AAUS, like the general plan here is everyone has these issues and everyone would love to just be low cost diversified in ETF, right? And as you guys all know, more scale means I have a capability to drive cost even lower, right? So we can do AAUS 1. It's going to be on a set schedule, and we think there's generic demand where we can pull it off profitably, right? Because, if you're not making a lot of money if you're charging 15 bips, right? Like, and all the fixed costs and brain damage. And so to the extent exchange funds are out there collecting assets, credible 351 contribution, we have all these people annoying us like, hey, when's the next one? When we think there's at least like 300, 400, 500 mil in demand, great, we'll launch series 2, right? And that's because our constraint, because of the law. Sri doesn't have this constraint. He can take, every day he can launch it, he could take contributions whatever the heck he wants. But we have the constraint. So it's not like they're paired off. It's just we're kind of building like the battleship slowly, and it's for everyone to take advantage of. But other groups have different ways to like collect capital, pull it together, and then we as the PMs on 351, when Sri comes to us and says, hey, here's my contribution I got. Like, is this appropriate for your guys' fund? Does it fill prospectus? And then we have to say like, well, yes, that's great, or no, you're going to dump me like 20, I could also say no, like you're going to give me a bunch of like crazy, private assets like SpaceX. That's illegal. I can't take that, but whatever. But so they're going to come to us, obviously have to propose something that we would want to accept naturally as managers of like this, S&P clone.
Right. Yeah. I mean, you kind of married a continuous net process on the exchange fund side with with a volume batch process, to put it in operations management terms,
yes,
right?
Exactly.
You've solved the time delay problem by creating a volume-based batch process. Yeah, it's clever. Not that it doesn't surprise me that it's clever, but that is clever.
Well, that's the plan, Dave. It may not work out, but we think it makes sense because it solves all these like problems. But
there's an actual timeline for AAUS. I mean, it's moving forward this summer.
Yeah, no, it's a live deal and it's funded. I got my dad in it, so now I have to launch it because he'll get.
Now you're in trouble.
Now we have to launch this thing. This plan is happening in real time. So
what's the logical floor on this, right? I can see that the $10 million Google guy, that's a fairly easy use case. What about that $250,000 Nvidia guy? Like, at what point does this become really not economically viable? Because to your point, we talked about how like somebody who's sitting on $10 million may only be able to get $1 million in on a given round, or may only want to get rid of that much of this exposure because they don't want the lockup. How low can you go on this before it really doesn't make much sense?
So I would say it is not a problem of how low can we go. Our minimums are 100K. Like, people can come in with 100K, and like one behavior that we've seen, especially because we close every 2 weeks, somebody with like 10 million of Nvidia says, I want to diversify out, but I don't want to do it all in one shot. Every 2 weeks, take 100K and like dollar cost average me out of it. But there are like, we were the first ones to say, this should be a product just for qualified purchasers. We should also serve accredited investors. We run both accredited investor funds and qualified purchaser funds. And it's really a calculation of how much gain you have and like whether diversifying with an exchange fund is a better alternative than just selling and diversifying.
Yeah.
And then the other thing, Dave, on that is operationally, like on our side for like 351s, as you can imagine, it's like it's a nightmare, right? Like a 100K client contributing into our deal is equivalent to a $1 billion client coming into our deal. So for us, like it actually matters. But Sri, because he's way better at technology, has figured out how to circle all the cats and deal with like 100K contribution, but it doesn't hurt me because now he's literally effectively one contributor. It's like he's equivalent to like the 100K guy at Schwab is the same amount of work as Sri, because it's from our perspective on 351, he's just one contributor. And so, hey, if you want to give me $100 million, I'd much rather work with Sri than I would, I still like to work with the 100K guy, but it's just, he's uneconomic, but I can't charge, there's no fees we charge, right? Because we just take deals or not. We don't have an ability to well, you pay 25 bips, you pay 5 bips because that's illegal with an ETF. So we can't even do that price discriminate, where he can because he's an LP. Every LP pays their own entry to the thing. So it also is a good operationally, it's solving that operational problem as well. He's dealing with the, smaller fries out there.
One of the interesting things here too is that you're kind of solving like a behavioral problem, because if the investor can't sell until 7 years, you're kind of like locking them up. I mean, they probably would have held their stock that long, or maybe they wouldn't have, but it's sort of, we all know that investors can be pretty flighty when it comes to holding and sticking with strategies and ETFs. So it's kind of like a good thing that lockup's there. It seems bad kind of from a liquidity standpoint, having access to your money, but at the same time, for long-term investors, it's kind of a good thing.
The natural personality of somebody that comes into an exchange fund is not that of a trader. We get all of these stocks. Somebody bought Apple in 95 and I think I've had a good run with it. Now I'm gonna diversify out of it. And essentially a lot of the folks that we get are also just busy with whatever else that they want to do. We don't think we get the trader group that is always thinking about optimizing and getting in and out of positions. That is not a good fit for an exchange fund anyway.
What should an advise to that end, like in terms of thinking about where this is a good fit or not? Obviously, we know that the fundamental consideration is they have a low basis, large single position. Like that's step one. What else should they be asking? Are there asset location issues? Are there jurisdictional issues? Where are there edges that an advisor would want to make sure that they've got established before they're making a phone call to either one of you?
So the good news is they don't need to make a phone call. They can just go to our website and just, check capacity. It shows them real-time capacity of how much of your Raytheon stock we can accept at any given point. And it's super simple. I can't think of any major constraints. Everyone that is entering the exchange fund, especially this one, needs to be a qualified purchaser, which is somebody with over $5+ million in investable assets. That is really the major constraint. And if you're coming from an irrevocable trust, there are higher limits. If it's an entity, there are higher limits. But most individuals, joints, and revocable trusts, it's 5 million. That is the basic requirement. Beyond that, there isn't really anything else that I would think about. And it's a lot of different kinds of investors that we see. Some are corporate executives, some received it through inheritance, some just invested at the right time, some got it as a gift, and then it had a major run up from there. Those are the various kinds of scenarios that you could apply it for.
Okay, a couple more nerdy little questions. I'm an advisor. I have a client who's in the exchange fund, whether it's done the 351 conversion or not. I'm in the exchange fund. How does this show up on my platform? How do I effectively charge against this? How often is it getting revalued? How much can I lean on that value? How does this show up if I've never had to deal with a private fund before?
Yeah, we've established DTCC data feeds, and all the major custodians, we are a line item. You work with Schwab, it just shows up. You send over Google shares, and the fund closes, and a few weeks later, cash exchange fund shows up, and the NAV is updating every 2 weeks.
Every 2 weeks. Okay.
Yeah.
So every time you're doing a new opening, you're doing a new strike. Obviously, that makes sense.
The other, I would say, unlock here is that advisors most often, like all of this concentrated stock, especially if you're a tech employee or some other highly concentrated employee person that has 80% of it in one stock, the advisor only gets to advise on this 20% outside of the concentrated portfolio. If they're not doing anything with that 80%, it is not under their mandate. This has become a huge growth lever for a lot of our like RIA clients.
Because it moves the assets under the billing. I get it.
What else you got, Dave? Throw more rocks at this thing. Try to break it, man. We've been trying for 2
Well, no,
years.
I've asked about cost. I've asked about liquidity.
I
I've
know.
asked about custodial issues.
Transparency.
Where are they? Where are you on the reg side of this? Because I've read enough about this stuff to think that you guys are doing this completely above board. I don't want to say anything negative about that. Seems like you've absolutely threaded the needle through here. Is there anything that you're worried about in terms of regulatory issues, in terms of FINRA or the SEC, in terms of things that could potentially happen in reconciliation or a future tax bill? What's the most at risk in all of that, if anything?
Yeah, the way that we looked at it, we needed to make sure that this is built as per the current regulations and make sure that the whole structure follows current laws. And Wes also knows we hired white shoe law firms and actually have 2 of them that are looking at it and incurred huge amounts
Sure, it was
of money
free. Yeah.
doing the research.
Pro bono,
and
Dave.
development. Yeah.
Yeah. And just so you know, Dave, this is something that literally until like 2 months ago, because it kind of been R&D, we went down various paths, and like the various paths, there was like known snags and like workarounds, but then one law firm would be like, meh, and then Sri and his team came up with like another genius wrinkle that just solved it, and now everyone's like, oh my God, Eureka. This was like the Eureka moment. Like, and that's where all of a sudden I was like, Roger that, we're punting our deal on AAUS. I have high confidence. All my guys have high confidence. This is money. I mean, they could always change act of Congress can cause any issues, but like, I feel very confident personally. It just, because I think Sri and his team kind of really solved the main snags. They were all kind of like, dancing around where, I mean, yeah, unless they have an act of Congress, we're 100% in line with the intent, the idea, its benefits for clients, for investors. Like this is what exchange funds in 351 were all about in the first place.
Yeah, and a 7-year lockup cures a lot of ills, right? I mean, something that's both transparent and that locked up, it's hard to accuse of doing anything wrong, right? I mean, you're definitely paying for this as an
there's snags.
Yeah.
It is not tax avoidance or evasion.
No,
it's just
I
tax
get it.
deferral. Yeah. And like there are a lot of things in the tax code that are much more advantageous for the end customer. This is just risk management essentially, and enabling diversification.
So if someone listening to this that wants to learn more about either participating or just get their arms around, this in more detail, what would you guys suggest that they do? Where should they go?
They can Google Cache Exchange Fund. It is CACHE Exchange Fund, and you'll hit our website. You can go through all the materials. You can schedule a call with us, and we do have a webinar coming up with Wes and Co. They can attend that webinar where we explain this in a lot more detail, and they can ask their questions as well.
And I think, Wes, equally as important, if someone wanted to understand what they were going to be getting on the back end in the ETF.
So, if you go to just, funds.alphaarchitect.com/AAUS, we have everything. The pitch deck, the prospectus, the one pager timeline. Like our stuff is obviously very like advisor centric. So if you need like the one pager that communicates the, the blocking and tackling plan, when you got to do this, or if you just want to talk to people, just hit us up. and then we're used to dealing with advisors. Cache is as well. And they have another guy on their team, Aaron, who I think used to be an advisor, right? Sure.
Yes, that's correct.
Yeah.
Yes.
So they're building the capacity, because as you know, like the consumer set of an advisor is different than direct to consumer. And, we've kind of we're built for the advisors now, because we shifted away from direct to consumer, and then Sri kind of started direct consumer, but now he's going to shift towards advisor. So between the two of us, just reach out if you're an advisor, and we'll make sure you're being treated as you'd expect to be treated as an advisor.
Great, guys. Well, listen, wish you the best of luck with this. It's certainly a really innovative development, and I think we've, covered it pretty thoroughly here. Dave, it passed the white hat test, I think.
No, it makes a lot of sense. I get what you're doing. It's clever. It's definitely clever.
So cool, guys. Thank you for joining us. We'll put links to the sites in the show notes, and keep us posted, okay?
You got it.
Thanks so much
Appreciate
for
the
having
time.
me.
Thanks for joining us.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.